Hi, everyone. This is Martin Lefebvre, Chief Investment Officer at National Bank. Thank you for tuning into this NBI podcast. Today, we're going to talk about inflation, economic growth, and markets with our Chief Economist and Strategist, Stéphane Marion. Stéphane, how's it going?
Good morning, Martin. I'm doing fine.
Doing fine. Excellent. So, Stéphane, we had the inflation numbers for the month of May this morning. Which was, I guess, not what everyone was expected. A little stronger than was first thought, especially owing to energy prices. What's your first take on the numbers?
Yeah, unfortunately, we didn't hit the peak that we thought we were going to hit. Energy was strong, as you mentioned, and the year-over-year actually accelerated this month for total CPI. And what was disturbing, Martin, was the monthly change was still showing 1% growth. If you annualize that, it's like 12% inflation. So clearly that was not what the market is expecting. But, generally speaking, you have to look beyond just energy or food. So if you look at core CPI inflation, it was a lot tamer, half the rate as you saw on the monthly change than the overall CPI. But at 0.5%, Martin, it's still 6% year over year, right? So, or an annual rate of 6%. So clearly, we need to see more deceleration going forward to avoid central banks becoming overly aggressive with.
Okay, so that's clearly the Bank of Canada has already risen rates by 50 basis points. So that's probably what you're expecting in much of the street for the Fed over the next couple of days. But what does it mean in terms of a terminal rate? Do you see them hiking rates much beyond that what was guided not so long ago?
So basically, you're asking me if we're going to go restrictive. Restrictive would mean 3% or above. I don't think we're there yet. Clearly, for the Bank of Canada, it's a little bit trickier because Canada is a net beneficiary of higher food and energy prices or commodity prices, generally speaking. And we saw that in the jobs report this morning, 40,000 jobs, about 130 full-time jobs. So clearly, there's a lot of momentum in the Canadian economy. I think the Bank of Canada could actually outpace the Fed in terms of rate hikes. But Martin, at the end of the day, the reality is long-term interest rates are also rising at the same time. So under these circumstances, that's these higher market rates are doing part of the job for the central banks, and that will cool the housing sector. So normalization is still in place. I think both central banks, Canada and the US, will go up to 2% relatively quickly. After that, they might slow the pace of monetary hikes. And the reason for that, Martin, is that we might see a cool down in inflation in the coming months. Just think about it. I mean, China has yet to reopen its economy, full-fledged reopening. So assuming that this takes place, we could see inflation slow in the second half of the year, and with a potential slowdown in growth, I remain hopeful that inflation will peak this summer and under these circumstances in restrictive territory, which would be obviously a risk for an economic accident next year if they were to do so.
Okay, next year, but markets are already down nearly 20%, which has historically never happened outside of a recession except for October of 1987. So what is the market telling us? Are we already in recession, or is it inevitable, or when do you see it happening, if ever?
No, we're not in a recession. Clearly, what the market is trying to see is that how do we stabilize? It's not that the market is down because profits are contracting, Martin, right? It's really a compression in price earnings ratio that reflects the increase in long-term interest rates, right? That's your trade-off when you look at investing in the stock market. So I think what the market is looking for is that what is the level of 10-year rates that stabilizes inflation, and that's what we're looking at. So our view is that the 10-year Treasury yield in the U.S. might be closer to 3.5% this summer. It's still a far cry from what we saw 20 years ago at 5% or so, Martin. But this is what we're looking for right now. We're looking for a peak on inflation, some stabilization in market rates, 10-year Treasury yields. And once we achieve that, and once we see this economic slowdown, slower inflation, clearly that will help appease the fears. But right now, Martin, I would say down 20% in certain segments of the market. Clearly, there's a significant economic slowdown is already anticipated. And we do believe that growth will slow down in around 2% in the second half of the year. Martin, That's still growth. That's not recession, by the way. Yield curves are not inverted. I don't see a recession happening in the second half of this year unless there's an exogenous shock coming from elsewhere. So right now, monetary policy is not restrictive.
Okay, and there's already, and a lot of risk already priced in at these levels, if I understand you correctly. Do you see any other risk that might come and haunt the market furthermore?
Mais Martin, the difficulty this time around is we're facing a supply shock, both on food and energy, reminiscent to what we saw in the 1970s. Back then, it was an oil shock. It's still an oil shock caused by the Ukraine conflict. Add to that the pandemic situation, which is not fully resolved in China. So the supply components are very hard to assess from a central bank's perspective, and even from a market perspective. How do you anticipate this? So the stagflationary component of what we're seeing right now is still with us. The risk to stagflation, however, is not a base case scenario, but the probabilities have risen recently, and we're probably at 30 to 40% probability of stagflation environment that could persist for longer. And that's the issue that the market has to contend with, because once you have stagflation, there's an inversion in intermarket activity, which makes for very volatile markets and uncertainty about the profit outlook.
So in your mind, is North America still the best place to be invested?
Historically, if you fear a stagflation scenario, Canada's always outperformed, given the composition of our economy. And Martin, that's still the case this year. The S&P TSX is still outperforming. We are a net beneficiary of higher commodity prices. And again, that's the reason why we had these very strong job creation this month. And that's why the Bank of Canada will probably outpace the Fed when it comes to monetary normalization. But as in the US, Martin, I doubt very much that the Bank of Canada will push monetary policy in restrictive territory if our scenario is right and we do get a peak on inflation sometime this summer.
Okay, well, Stefan, that's all the time that we had this morning. Thank you very much for your comments, and everyone, thank you again for tuning into the NBI podcast, and we'll be talking to you guys once more next month. Thank you very much.